Hi, my name is Montalbano and Leland Yates, and this is our interest rate forecasting project. To start off, I'm going to give some highlights about what happened between October 7th through the 31st. We'll start with the FOMC, which is the Federal Open Market Committee. Has a meeting on Wednesday to end QE. Now, quantitative easing is when the Federal Reserve Bank was purchasing bonds just to keep rates down. Energy crisis, oil is all-time low at almost $80 a barrel. And in Japan on Friday, buys many bonds and global securities, which makes the global market hit an all-time high. Just to give a brief statement as well, Friday, October 24th, the 10-year note yield was at 2.26%. Now I'm going to talk about Monday and Tuesday. Not too much has been going on in the market. Everybody's expecting the QE Wednesday, so the yields have been increasing slightly by maybe 3 basis points. Monday's 10-year yield was 2.27%, and Tuesday 10-year note yield was 2.3%. We do expect the bond market to grow. And as you see here in the yield, we really don't see that much increase. We may see it by a couple basis points here, but it's relatively stable, as well as the Monday and Tuesday forecast. Same, just a little bit increase for the forecast. Now, Wednesday, October 29th was a big day for the market. The Federal Reserve has spent the last 6 years post-crisis to keep rates down, but then Wednesday afternoon they did end quantitative easing. The reason why they wanted to end quantitative easing is that the government was seeing job growth in the economy. They see the unemployment rate was down, so they didn't feel like they need to push that much more money into the economy. Inflation has been running below the Fed's 2% target for more than 2 years, and then the 10-year Treasury note is at 2.3%, which is a 3-week high. Keeping short-term bonds low caused the yield curve to flatten. As we see here in the yield curve, as we see that now, we see more people getting out of the short-term rates and investing more into long-term. That's why you see it almost flattening. As well as you see in the forecast, we see the yield curve. We see the bond of the short-term increasing, but the long-term flattening as well. Now I'm going to give it over to Lee, and he's going to talk about the rest of the week.
Hi, my name is Leland Yates, and I'll be finishing up the rest of the week. So on Wednesday, they announced the end of quantitative easing, which basically means all the money that the government's been pumping into the economy to keep interest rates low, they decided it's time for us to kind of take the reins and we're going to go. So Wednesday was a huge day in the market. Following Wednesday was Thursday. Thursday wasn't really a huge day in the market. With the announcement of the Federal Reserve and with the Federal Reserve ending QE, basically what we're going to see is we're going to see interest rates as well as prices and everything begin to rise in the United States. This actually caused the euro to fall lower on Thursday to about 1.2572 euros per dollar. So it's one of the bigger drops that the euro has had in a very long time. So we can see that the announcement of the quantitative easing program ending is not only affecting U.S. markets, it's affecting global markets as well. Friday, on the other hand, was a huge day in the market, as well as Wednesday. Basically, the biggest headline on Friday was the fact that the Japanese are selling their own 10-year Treasury bills and buying the United States, as well as other global securities with it. Basically what this is doing is it's decreasing the value of their own yen, which is increasing the value and the demand of the United States dollar. As well as purchasing U.S. securities, they also purchased a fair share of global market securities, which means global markets were at a high on Friday. So every market in the world, minus Japan for buying all of that, they all experienced global highs on Friday. The U.S. dollar also reaches a 4-year high, which basically means in the last 4 years, the end of quantitative easing, there's enough confidence in the market that the dollar is pumping up against its other competitors in the currency market. Therefore, the U.S. dollar reaches a 4-year high, so higher than it's been since 2010. Essentially, since right after the financial crisis, the dollar's finally made a rebound and it's beginning to go up. As the dollar goes up, however, crude oil and gold are taking a hit in their markets. Basically, the way that it works is as the value of the U.S. dollar goes up, it takes less of the U.S. dollar to purchase these commodities such as energies, gold, and these oils and things like that. So this is actually driving the price of crude oil down. For the last couple of years, a barrel of oil has usually sold for typically over $100 a barrel, and today they were selling at $80 a barrel. So we can see that oil and gold, the commodities markets, are taking a massive hit from the value of the dollar at the end of quantitative easing. Here we have our Wednesday through Friday forecast, and just like Cole stated, Monday through Wednesday through Friday, you can see a little bit greater in the market where people are getting out of these short-term securities and they're going to the long-term securities. You're starting to see a greater increase in the forecast as far as the interest rates going up. But then on the yield curve, you can actually see, we have a couple of large basis point changes right here in the middle. But then you can see here at the end that the yield curve from Monday through Friday, from when they made the announcement, the yield curve is beginning to flatten substantially here at the top end on the long-term rates. Here's our Wednesday through Friday yield curve. There's not really too terribly much change as far as the yield curve goes. It's relatively stable. Once again, we can just see the steady overall over time is beginning to flatten. The yield curve between Wednesday through Friday is beginning to flatten. Our Monday through Friday one-year forecast, once again, we can see that people are taking their money, once again, out of short-term markets, and they're putting it into these long-term securities, which is ultimately driving the spread and the price between these down. We can also see right here on the 10-year notes that we also believe that the Federal Reserve is driving the price of these 10-year securities down to attract the Japanese and other global investors to this 10-year security. So we can see that we believe that the sharp decrease in the rates right here is going to be because we do believe that the Federal Reserve is having some sort of influence still on the 10-year rates. Here we have our weekly yield curve comparison. We can see that between Monday and Friday, this being Monday and this one being Friday, we can see that from the beginning to the end of the week, the yield curve has substantially flattened on the low end, with more and more people driving the rates of these the yields of these securities down. Once again, we have our entire yield forecast. We can see that here at the end, a lot of people are getting out of their short-term bonds, and this was calling the huge volatility of all this, as well as the decrease in the prices here at the end of the week for the decrease, and the flattening of the yield curve as well. So what we have in conclusion, short-term rates, short-term securities will have a greater demand in the price, which means people are going to be selling their short-term rates, they're going to be getting into their longer-term securities, which is going to be driving the rate of these long-term securities down. So over the week, we've seen a steady flattening, and we can also continue to see, if things continue like they are, we continue to see a flattening of the yield curves. More and more people are starting to go into these long-term securities, driving the rates of the short-term up and driving the rates of the long-term down. Basically what the Fed has done is they've decreased the supply of money, which is causing the demand of the bonds to go up, which is driving the prices down. Something else we've seen this week is, once again, the commodities in the oils market are hurting tremendously with the value of the dollar and quantitative easing. And we also do believe, we notice in some of our forecasting graphs, we also believe that the Federal Reserve is still artificially influencing the 10-year rates to attract the foreign investors. So we can see from the beginning of the week that the yield curve is beginning to slowly flatten as more and more people are buying these long-term securities. So if you're an investor or anything like that, many investors are beginning to move their money from short-term into long-term. This concludes our presentation on the interest rate forecasting for the week of October 27th through the 31st. Thank you.